In business, Singapore's largest bank, DBS, posted a net profit of $2.9 billion in the first quarter, but it was a 2% on-year drop. This was largely due to higher expenses from the global minimum tax of 15% implemented this year. Without that, the bank would have achieved a record profit before tax at $3.44 billion. DBS also added $205 million to its reserves as a precaution for future risks brought on by US tariffs. Now, one analyst says that while the impact will likely be felt from the second half of the year, DBS is well positioned to ride through the storm.
So the deposits rising is a good thing for a bank, right? Especially for DBS. When we saw CASA or current account savings accounts ratio rising, that is a good indicator, that the funding costs have been lowered for the banks and specifically for DBS. And that will help them to sort of buffer the net interest margins decline that we are sort of expecting, with the interest rates dropping.
That's one analyst's opinion. CNA's Elizabeth Neo spoke to DBS CEO Tan Shan about the bank's latest results.
Higher tax expenses that weighed on the Q1 net profit. I think that figure came in at about $2.9 billion. And how is that 15% global minimum tax reshaping your profit outlook as well as your tax strategy?
Yeah. So the BEPS will affect our tax bill and increase it by about $400 million this year. And obviously, we will also see some headwinds around net interest margins as rates have been cut. They were cut by 100 bips last year. We are expecting another 2-3 cuts this year. However, we hope to make up for that through a rise in volumes, both volumes from deposit growth and volumes from asset growth. So net, we hope to see that our gross profit remains pretty stable. We delivered a solid first quarter, and that was led by wealth management. We had record wealth management fees. We had record loan fees. We had record treasury sales fees, and we had a record, net PBT, profit before tax. And that all suggests that we were firing on all cylinders, and the structural business and growth engines that we have built are pretty solid. So the second quarter looks kind of okay as well, barring any major tariff-induced accidents. However, I don't think business leaders like uncertainty, and neither does the market. So there's been very high market volatility, and business leaders are pressing the pause button on their big business investment decisions because they want to see some clarity before they go ahead. But having said that, we saw good non-trade loans in large corporate deals in the first quarter. DBS led a lot of these syndicated loans. We were the market leader there.
And this is just about the share price, which had taken a hit from the tariff concerns, and it's since trimmed its year-to-date losses to around 0.7% as of this afternoon. Are there plans to further purchase the stock?
We announced a $3 billion share buyback a few months back, and we are still committed to fulfilling that. We can do that anytime in the next 2-3 years. We'll tend to do more when the stock price is lower, obviously. And we've done about 9-10% so far. So we're committed to that. We also announced a capital return program, and that was 15 cents per quarter. So that's about 60 cents a year. So the 15 cents per quarter capital return is 60 cents a year, and that's about 1.7 billion a year. So times 3 years, that's about 5.1 billion, and plus the 3 billion share buyback, that's about $8.1 billion. That's coming from our capital stock that we've accumulated over the last few years. So we've made the commitment. We'll stick to that. The rest of the dividends will come from our normal earnings, and at 60 cents a share, that's about 64% or so dividend payout ratio. That's quite manageable, and we should continue to do that.
Ms. Tan also talked about the risks arising from trade tensions and tariffs. Now, the lender has significant exposure to India and Greater China, and we asked how it was insulating itself from the volatility in these regions amid rising geopolitical tensions.
Tariffs are here to stay. It's just a matter of how high. And I think China, through Trump 1.0, has already learned to insulate itself. They've become more resilient, both in their own supply chains, their food security, their semiconductor chip security, their energy security. They've done very well in EV supplies and battery storage. They are already investing big time in renewable green power. We are seeing more wealth flows in Hong Kong and China, and that's good. That speaks to, and if the markets continue to do well, then that consumer confidence can spill over to the wider, to Main Street from the stock market. India's a structural growth story. You've got the rising middle class. You've got a great India technology stack, which started in 2016 with the digital ID, the Aadhaar, which started also with the UPI, which is the payments gateway. That's enabled the country to digitize themselves, to collect and receive payments digitally. That creates good digital pathways for banks like us to make better informed credit decisions. And it also enables us to acquire customers quickly and more efficiently. And we're seeing good growth in our corporate banking business, in our SME business, and in our consumer business as well.